We're live?
Sorry. Yeah, we're live.
We're live. Okay. People can hear us. Hey, guys. What's going on? Happy afternoon. We don't usually do afternoon streams, but the announcement has come out. 50 basis points is the answer. We had articles right here coming out today just minutes ago. Fed raises key rate by 0.5 point in bid to tame inflation. So a couple things. I want to read this. We're going to interrupt. We're going to look at the charts today. I'm going to get T. Shroom's take. I'm going to get Kelly's take. I'm going to get Smay's take. Kelly was the only one that was right. This morning, he predicted 50 basis points. The rest of us went 75. So, first of all, applause for Kelly. Way to be right. If we are right, though, about 50 basis points, we should actually see Bitcoin potentially rise. But anyway, the Federal Reserve intensified its fight against the worst inflation in 40 years by raising the benchmark short-term interest rate by 0.5 percentage point. Wednesday, it is the most aggressive move since 2000. So that's key point. This is the most aggressive move in over 20 years. The increase in Fed key rate it raised in a range of 0.75% to 1%, the highest point since the pandemic struck 2 years ago. The Fed also announced that it will start reducing its huge $9 trillion balance sheet, which consists mainly of Treasury and mortgage bonds. Those holdings more than doubled after the pandemic recession hit as the Fed bought trillions in bonds to try to hold down long-term borrowing rates. So this is really interesting. It's coming out here in literally less than 6 minutes. We're going to actually go live to Powell and hear what the reasoning is, what the perception is going to be going forward. Real quick, I'm going to throw it to Kelly and get his take. He was right, but I want to just give you guys a look at the chart. Here's the 4-hourly chart. We are red. If I go down to the 15-minute candles, these are the ones we're probably going to keep an eye on throughout the stream and notice what's happening to the price. But right now, as of this second, it is actually red. We're a little bit down, although I wouldn't be too concerned because we do think or believe that the 50 basis points price prediction was kind of worked into the dip that we've had over the last couple of days. But Kelly, I want to hear what is your take? What are your thoughts now that it is official? It's only 50 basis points instead of the 75.
Well, just first off, since we had a little bit of technical issue starting, can you hear me? Everything good?
Yep, we're good.
Awesome. Well, welcome back, everybody. Happy to be here and go through this with you all. We had the 50 basis points. I don't know if it was a manipulation thing or not, but the truth, we had that massive sort of over 99% CME futures participants basically trading towards 75 or higher basis points. So the fact of the matter is the 50 basis points was definitely baked in. Price hasn't really moved much on the markets. I don't know if my screen sharing is on, but I know you guys are going to go over that in a lot more detail. But okay, it looks like he's doing it now.
You got it. Go for it.
All right. So I basically have very quickly, I've got the Bitcoin here, the Dixie right below it, the basically S&P 500 and Dow Jones right here. And you can see the dollar index has actually pulled back a little bit on this news, but this is obviously still within a pattern. Dow Jones is getting a little bit of a pump here. S&P 500 getting a little bit of a pump, but at the end of the day, what we're really looking for here, and what the market's really going to be looking at right now is what is the verbiage? What is the tone? Is it dovish? Is it hawkish? What is the guidance that is being spoken? And is it a manipulative guidance? Is it honest guidance? Like, what is the entire tone? And that's really, we might see all of these charts that we just showed, that I just showed a second ago, they might all trade in that complete opposite direction based on that tone. So right now, it's a good thing that we've been planning on this 50 basis points, and it came in. So we shouldn't see any sort of massive downturn on the market. And I'm still standing by my hodl number for Friday for Bitcoin above 40,000. So yeah. That's my thoughts.
I will say you are looking like a good front runner to win this week's hodl trophy. But I want to hear, because what you just said, you're happy about the 50 basis points. I have a feeling that there might be some debate coming from T. Shroom, where I think his take is actually he would have preferred the max pain coming now rather than later. So T. Shroom, what are your thoughts about this 50 basis points call instead of 75?
Yeah, I would have preferred the max pain, although 50 is still very hawkish for the Fed to have done this. So if I could really quick just kind of cite some of the reasons why they cited doing this. So if you go to my screen, Smay, so I'm on the actual federalreserve.gov website. Some of the things that they've talked about was weakness in the overall economy and how it edged down in the fourth quarter. But they said that housing and spending business spending remained strong. Job gains had remained robust in recent months, so that also influenced their thinking. And then they, in the second paragraph, they also talk about the Ukraine and Russia conflict as well as the Chinese supply chain distribution being exacerbated, and so that would slow down goods being able to be produced there and get moved around in the world. And that issue was sparked by increase in the pandemic moving in China. So you can come back to me. I mean, ultimately, they're citing things that have been very popular in the news. None of this should be news to you, hopefully, and but this is all what's been informing them at the FOMC on what they should do with this rate. Yeah, I think this, even though we predicted, the three of us in the room, not Kelly. Again, Kelly predicted this correctly, so good job for him. The reason we predicted 75 is there's also the large betting. A lot of people betting on CME futures, they predicted that it was going to go 75. As hawkish as this is, in all reality, this is actually another semi-dovish move, and this is actually becoming consistent. It'll probably factor into how I predict these things in the future, because it seems almost at every single step they've had two options, a hawkish one and a dovish one, and they've chosen the dovish one. The metric keeps changing because of the rate of inflation, but back in January, a lot of people thought they should have gone ahead and risen it by 25 basis points, but they decided, no, we're not going to do it in January. We'll kick it down the road. Then we got to January, and we got to February and March, and there was debate on whether it should be more aggressive up front at 50, and they said no, we're going to hold off a little bit, and then we're going to do it by 25. And now it's getting to the point where, again, a lot of people even thought we should have gone ahead and, as you even said this morning, rip the Band-Aid off T-Shroom and go to that max pay and go 75. But instead, they're going to keep 50 is hawkish. It is an aggressive move. But if anything, it actually might be the more dovish move of the two. So what we're about to do, Kelly, we're going to hear more from you on Friday. But if you guys want to go hear what he thinks, I'm sure he's going to be posting on his Twitter, @KellyKellum. Make sure you guys go follow him. But we can't have his Zoom call up and still stream it live. And it's about to be here on camera. So, Kelly, we'll see you Friday. Adios.
All right. I just want to say, no matter which direction the market moves, it's going to either retrace back up or pull back down. So I'll be sticking here with you guys in chat. So we'll see you guys on stream.
Awesome. All right, we're gonna keep our comments to a minimal during it, but we will comment if we think something is interesting as it goes. And then here's what we're gonna do: if it goes much longer than a half hour, and it doesn't seem like there's any insight, we might stop the recording and have a quick discussion before closing it out. I think I've seen some of these go longer than a half hour. Some of these have gone shorter than a half hour. So we'll have to see how that goes.
Here he comes. There you go, guys. I'm going to unmute it now.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services.
Big red candlesticks on NASDAQ.
The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store.
What do you mean surprised, though? This wasn't a surprise.
We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
So really quick, Smith, before they get into the questions, if you want to jump on my screen. So
Nick Timmerose of the Wall Street Journal. Chair Powell, the unemployment rate.
if you want to, just cut the audio really quick. So the Nasdaq down here at the bottom left side has regained some of its losses. Bitcoin has done the same, and they're moving pretty much still in tandem. The U.S. dollar, that Dixie index we've been talking about, had a very precipitous incline with a big green candlestick here up to 0.34% increase, but then retraced all of that back. So the market is, I would say, kind of unchanged. It's had a very modest movement as a result of these comments and the data released. And I'd say that it was baked in to all the markets. They had it baked in like we were thinking. So you can go back to Jerome now.
50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
So
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them.
So one other thing that
Hold on, hang on. Let's go. Let's hear the questions. Do we want to hear the questions we
Percentage
asked?
point possible. And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for
That's a good
for the
question.
level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out, and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort.
Which means next month,
as I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled.
NASDAQ
that
and
inflation,
Bitcoin
in
coming
fact, is
back
under
up.
control.
Yeah.
And starting
XE
to
now
come
is
down.
going pretty low. If you want to look at my screen, I've got those pulled up.
Again, it's not like we would stop. We would just go back to 25 basis point increases.
Yeah, so
it'll be a judgment call.
I think what he just announced buys a
again,
couple
our
months of
expectation
nothing
is
higher than 50 basis
what we
points.
expect to see,
So we can get that price worked in a lot sooner and know it's coming. Like I said, he pretty much just admitted 75 will not even be on the table for the next couple of months.
Thank you. Colby Smith from the Financial Times. Given the
You turn it back up.
expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral.
NASDAQ
But
really
we
pumping
know that
now.
there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You know, you're going to raise rates and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Yeah, but he just said that it's going to be really hard to determine they need.
Thanks, Chair Powell. Neil Irwin of
So
Axios.
that was a
Do you
stupid
see
point.
evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated, and you can look at that and say, well, that's because people expect inflation to come down, and in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture, but it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point, was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately, or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored.
Cardano
It's
up
just something that we can't
10.4%.
allow
Yeah,
to happen,
Cardano's
so
up 87 cents.
we'll look at it that way.
Yeah.
It's interesting that it's leading the market by such a significant margin.
Again, the technicals
Thanks, Chair Powell.
were sitting there
Gina
for
Smilik
it
with
too.
the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those. But there's a job to do on demand. And that you can see that in the labor market, where demand is substantially in excess of supply of workers. And you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things. For both the situation in Ukraine and the situation in China, they're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path. So, but the second thing is that they're both capable of preventing further progress in supply chains healing, and so, or even making supply chains temporarily worse. So they're going to weigh on the process of global supply chain healing, which is going to affect broader inflation too. So in a way, they're two further negative shocks that have hit really in the last, 60 days, 90 days.
You want to just chat amongst ourselves? We want to keep hearing these
Let's
economic
do a
questions?
couple more questions, and then we'll go.
Hi, Victoria Guida from
ahead,
Politico.
question.
I want to follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved, since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try and get inflation
that
back down
word,
to where you
crimp.
want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2 to 1 job vacancies to unemployed people. There's a lot of excess demand there. more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and I mean that's part of our job too. So we'd be watching that carefully, and it puts any central bank in a very difficult situation.
The Dixie coming down quite a bit.
Yeah, it
if you
is.
want to come to my screen,
Almost
I've
a
got
full
it.
percent.
Howard Schneider with Reuters, and thanks.
A couple
Nice
more
to be
questions,
back.
then we'll have our
So,
session.
two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place where the labor market appears to be more in balance, and that depends not only on the level of those things. It depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the beverage curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1 to 1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending. And then you can think of another big one as asset values broadly, and there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Rachel.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes?
That's a really good question.
How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people
that's
don't.
Nice. That's a good way to put it.
When they experience it for the first time, you're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy, and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates. So higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
We can go and go away.
Thank you, Chair Powell.
So even that right there, we will do everything we can within our power. No, you will not, because you could have put 75 basis points, but you even admitted you didn't even consider 75 basis points this time. And then you went so far as to say that it's not even really on the table for next one because 1 month of data is not enough to actually give you enough information to make that kind of aggressive opinion. So this is actually something, and I want to hear your guys' thoughts on this as well, and I want to hear your guys' thoughts in chat as well. But we speculated about this morning on Coffee and Crypto. We actually gave kind of a short-term and long-term prediction after hearing not just what the announcement is with 50 basis points, the thinking that is coming out. I actually have a completely different thought than what was posted on Coffee and Crypto. I actually think that this could actually be short-term semi-bullish, but not a lot. Again, it's what people expected. The price had kind of been baked in already with the dip. It's going to climb back up, but it's not going to do it at a significant level, and we're going to continue to be drugged down the road month by month. And he kind of hinted at, okay, well, we won't have an aggressive one next month or maybe a month after that. So here's what's going to happen. When eventually, because this is not going to curb inflation. Inflation is going to keep rising. So like I said, things like Bitcoin should be attractive. Things in crypto should be attractive. It's still kicking the can down the road. And while his words out of his mouth are, we're doing everything we can, that is not true. They are not doing everything they can. They don't want people to be upset with them who don't fully understand how this works. I actually, again, if there had been different reason and different rationale and different thinking that he had come up with, might have said, okay, I understand why they're going light this time. But his even kind of confession of it wasn't on the table this time, and unless something crazy happens, which, what's their definition is up to them, it's not up to us. It's not even on the table for next month. Low-key, I want to see how the market responds over the next couple hours, next couple of days. I do not like that rationale. I don't like that reason. Not that I should really be that surprised because, as we talked about this morning, every single time they have gone with the more easy way, more this is going to get us better attention publicity-wise, or they're going to make people think better of us. If we go too crazy far, people aren't going to like us. And unfortunately, he is right. Inflation is crippling to people. Not having stable prices is crippling to people. And what he's doing is not aggressive enough to fix it. So I want to hear what you guys think. I'll start with you, T-Shroom. What are your thoughts about what you heard in that announcement?
Well, he has such a calming and such a reaffirming way of speaking. It really makes you think that they do know what they're doing and everything's under control. But in the back of the closet there at the Fed, they've got $30 trillion of debt. We have $30 trillion of debt as a taxpayer. And it's unsettling for them to be so calm and so collected when we're in such a dire situation. But, that's just the way that the wheel keeps on turning. And do I wish that they'd done the triple rate hike? I do. I think that would have shown the market that they're serious about recovering, and they're serious about getting inflation under control in a real way. But what's easier to do is when asked the question, like Jerome was just asked, like, what do you say to poor people who have, bananas and bread that are way more expensive? He just said, well, you're going to have to endure it. But it says it in such a comforting way that it's like, okay, well, we'll just endure it and everything will be okay. So I don't know. We'll see.
No, I mean, he is saying what he needs to say and saying it in a way that he wants to say it so that people who don't know what's happening will think that this is okay and this is actually a good decision. But I can't remember exactly what it was, but the fact that he said they weren't even considering, what was it? There was a point someone asked, and he's like, well, that's not really one of our considerations. Like, well, that absolutely should be one of your considerations. The entire economic state of the country and of the dollar should be under your considerations. And then for you to say, well, we want to address something, but we don't have a goal in mind. I'm not saying you have to pinpoint it to the exact metric, but to not even have a goal. So you're kind of giving yourself an out down the road that if it gets a smidgen of a bit better, well, then technically all you said was we want to make progress. And it's not really actually fixing anything. It's still getting worse. Inflation's still getting worse. But technically speaking, you said, well, that's a win because it got slightly better in that particular area. This is, man.
Yeah.
Again, this is going to impact. I didn't watch the other ones. I'm really glad we're doing this. We're going to do this now, month to month, live watch his rationale, his reasoning for his answers, because it gets a lot deeper. I think it's, if people just listen to the number and not the reason, the rationale, the why, they're missing out on a lot of what they should be understanding about this. And again, I would have, if there was different reasoning, if he had come out with more numbers, if he had come out with more rationale, if he'd even said, hey, we addressed it, we looked at it, we honestly believe this month it just needs 50, but hey, if this doesn't work well, next month we'll go to 75, I might have been like, hey, this could have been a good announcement. But the fact that, like I said, he didn't say these words exactly, but he meant this is what he was trying to say, is that, no, we're not going to 75. That's too aggressive. That's too much. He even almost addressed it as if in his mind there's a chance that we'll be good to go back to 25 basis points next month. That's ridiculous. It's not going to work. Inflation is going to keep going up. And again, if you go to my chart real quick, Smay, this morning, what we kind of discussed with the potential, again, predicting we were going to see 75 because we thought Powell would actually do his job and do what he needs to do to, in his words, do everything they can to curb inflation. We thought there was going to be a hawkish news. We thought the price might come down even as far as 32, but then there could be a spring that sends us back up. Unfortunately, what he just said, more than likely, instead of seeing that type of price action, I want to fix my screen so I can draw this correctly. Low key, I actually kind of wonder if we're going to see some of this. We're going to see some bouncing between these two levels. We might even get people feeling good because we start to creep into the mid 40s, maybe even get up high as 50. And then what's going to happen is finally they're going to have to do something horrible, or it's just they're going to have to finally have that pain. I still think 30s, low 30s are in the cards. The question is when. Unless something different happens, it's going to be a little bit more time than we would like. Again, the reason why we wish that it happened now is because the sooner we come down to these levels, the sooner we deal with the max pain, the sooner we deal with inflation and then set up the situation that the institutions wants, the whales wants. We get retail investors back to stability, price action. And, as he said it over and over again, one of his issues is he wants to work on supply and demand. As soon as we fix those things, then we can go up. If we can do this and come down sooner, we'll get up sooner. But the longer we put off, and if we go out to the weekly chart, if we just keep dabbling this is where Novogratz talked about this. Novogratz predicted the rest of 2022 we could stay between 30,000, 50,000. Unfortunately, that's actually very realistic. We might be seeing this happen the rest of the year and stay sideways in this little angle, just capitulating and moving sideways because Powell and the rest of the Fed doesn't have the bravery and the there's lots of words you could use there to do what they actually need to do. But they're good politicians, and you guys are saying that in chat. They are good politicians. Like you said, T-Shroom, he is very calming, very soothing. They chose the right actor to go out on stage and to present their notes, but they didn't choose the right decision makers. So
yeah. So you might be asking yourself, then why is the market pumping? The NASDAQ up quite a bit here, up more than 3%. Bitcoin also doing well on the day for sure. I think that the reason why you're seeing green candlesticks pointing towards the sky here is because there's just generally more certainty now, right? A few hours ago, before we got the numbers, there was a lot of uncertainty as to which way the direction of the economy was going to be going, whether or not investors should be risk on or risk off. Well, the more information that we get, and the federal fund rate is a big piece of information in the calculus of investors. Now we have that, and now they can plug that into their calculations and say, okay, I can allot this much of my investment budget to XYZ, whatever it is. And that's why you're starting to see more than likely this money is flowing in because it's wanted to flow in, but it just needs certainty that either the federal fund rate's not going to go down or that it's not going to go precipitously up. They needed some certainty. So whether it's up or down, folks have their preferences, and so now they know that their preferences have either been met or they have been under met, and so they're choosing what they were already going to do at this point in time, and that's why you're seeing kind of a spring into action, a lot of pent up movement now being released, and you're also seeing high volumes. If you're still looking at my chart, you're also seeing higher volumes than usual, especially on the NASDAQ. It's pretty intense down here. Bitcoin has had definitely more volume in the last few minutes, but it also had some pretty high volume yesterday at close as well. So I'm feeling pretty optimistic. I'm definitely liking the way that the stock market and Bitcoin is taking this in stride. I'm also liking what I'm seeing on the Cardano chart over here as well. I've just got it online because it doesn't look very good with the candlesticks. But that looks a little better.
So do you feel, so here's, because my take is more of a long-term look. Like I said, I actually think that we could see another $50,000 Bitcoin semi-soon, especially with kind of this almost protection of saying you don't have to worry about a significant hike for the next at least 2 months. That's going to buy investors and traders some time to continue to pick up supply and raise it, but it will not hit a new all-time high. So when you say you're optimistic, because if we're looking at the 15-minute chart, or if I'm looking at the hourly chart, I am optimistic. I do think that in the short time frame that Bitcoin price will go up. But here is the problem. Too many people will accept short-term small gains. And what I mean by that is a lot of people almost act as if you told them, hey, I'll raise Bitcoin by 20% right now, and you can make 20% gains, or you wait a year and I'll raise it by 300%. I think people would like to say they'd choose 300 in a year, but in reality, the way they make decisions, the way they act, the way their brain operates, they internally actually would prefer the immediate 20% gain. And so, yes, short term, maybe even the next couple of months, next 2 months, we might actually see some bullish movement as we slowly but surely climb back up to 50. But then there's going to be pressure because there's still the unknown. There's still a lot of things happening there. The retail is still going to be flooded out of the market because they don't have the money. Inflation is going to still climb, and people are going to have to worry about, as much as I want to keep my money in Bitcoin because I believe in its future, I don't have the dollars in my account to pay my bills. I have to liquidate crypto to pay for my mortgage, to pay for my rent, to pay for my groceries, to pay for these things because inflation's not stopping. You're telling me you're going to trade Bitcoin getting to 50,000 here in the next 2 weeks, 3 weeks for a longevity of gas prices going up and grocery bills going up and rent going up. And, right now, like, good for him. Like, people are certain. I have friends that are buying houses right now. That's something my wife and I are looking at. But as he just said, those mortgages are going to keep going up. It's not going to be a good time to buy housing, but rent's going to go up as well. And there's always that dynamic that you're kind of splitting yourself in. It's like, man, even though technically rent, I have to put less money down and I can get away with it lower, I'm effectively flushing that money down the toilet. I'm not investing anything versus if I have a mortgage, even though that costs money and even I'll have to pay it, at least I'm kind of paying myself and I'm investing into something. But then with this dynamic, that becomes less an option. I think people are internally who are super excited about the short-term pump are disregarding all of that information. Whereas if we went ahead and allowed that max pain to happen right now, if we allowed that inflation to get under control more quickly within the next couple of months, and again, that would still be hard, but at least we should try, and then Bitcoin goes down and things get a little hard, but it gets better sooner, and then the rally happens sooner, I think people are looking at instant gratification a lot more than they're looking at delayed gratification.
Yeah.
You can go off
Definitely.
my screen,
Well, super chats or anything like that?
I saw one earlier, but it was more like just thinking and saying that if I scroll, I might be able to find it. I didn't record it. This wasn't a stream we were thinking. Again, we're going to be doing these every single month, and you'll probably see a lot more of these. Anytime there's a big announcement coming out, we're going to do a much better job of going live, giving you guys updates, what is happening. Are there any other thoughts or anything you guys saw in chat that we should discuss? Or is it time we're going to wrap this out?
I want to hear what Smay has to say, but if you go to my screen really quick, these are the next couple meetings that are coming up from the Federal Reserve when they're doing more of these rate decisions. So the next one will be June 15th, followed by July 27th, followed by September 21st, and then the 2nd of November and the 14th of December. So it's not every single month, but it's almost every month. So we've got 5 more left in the year.
All right. So my thoughts are, ultimately, I found it really interesting. And I kind of was on the same wavelength as T-Shroom when I was listening to it. It was almost like this really interesting, sobering almost like way that he was kind of talking about it as if it was like, yeah, we got it, man. I understand. You just got to understand. We've been through it. I laughed internally because he was like, I'm old enough to know what hyperinflation looks like. And it was bad. I'm like,
that was funny.
And I'm just thinking about it, and I'm like, it's not like, I think what they're kidding themselves is that they think it's going to get better, but it's not that it's getting better. It's that they just keep, like, it's almost like they keep slowing it down, and then it still gets ahead of them eventually. It's not like it's not like things are gonna get cheaper again, and the fact is, you go from 100 years ago to now. The dollar is lost so much of its value, and they've done all kinds of these shenanigans, and it's never gotten better. Right? They've only been able to slow it down. I'm not batting an eye at what he's saying at all. I think at the end of the day, especially the way he kind of tried to avoid even the way the lady was like, so what can people expect? How is this going to affect the average Joe? He's like, well, it's going to hurt, but you'll be all right because it's for the greater good. And it's like, at the end of the day, that's what we've been getting fed as a people for so long. How long can we continue to just go to sleep at night with that narrative in our heads? Obviously, it's not true. So at the end of the day, I think this to me overall, more than just what's happening this month, is proof that Bitcoin is so powerful and so necessary, because the greater good, they don't have it in mind. So.
Here's the thing. I saw in chat, someone was like, well, this is good for traders. Tim, they're still traders to make money. Here's the thing. Volatility will be in the space now, whether we go up or down. So traders, you're actually good either way. Whether the price goes up, whether the price goes down, volatility will continue to exist. The marks will still be there to continue to show you tops and bottoms. And here's the thing. I'm not even necessarily upset about the price just staying neutral. If it stays neutral, that's fine. Again, gives you more time to buy supply. This is the reason I'm upset about this decision and the way it was done. A, Bitcoin's going to go up temporarily and then come back down. So you're not going to be making money in Bitcoin, because there's going to be a lot of FUD and fear out there to keep it down. Also, economically, your US dollar is going to lose value. So the reason if you could tell me that this decision actually is going to fix inflation and is actually going to make things more affordable and is actually going to add value to you as an individual, but Bitcoin price is going to be suppressed for a little while longer, I'm fine. You know what? It gives me more time to turn that fiat into crypto, right? However, what I'm thinking about is the people who both are going to be struggling, because just because they're not buying more Bitcoin or more Cardano or more Ethereum doesn't mean that means they have enough money. They both won't be able to buy Bitcoin, Ethereum, Cardano and invest in their future, and they'll still be struggling to pay their bills. This is a loss not just for Bitcoin long-term, but a loss for people's livelihoods long-term. This is not a responsible move, and especially, like I said, it isn't the 50 basis points. The 50 basis points are fine. It is the thinking that the Fed is using, that they're keeping a foot in each camp because they're too scared to actually step out and do what they need to do. And that is to actually fix inflation. And like he said, we'll do everything we can to fix inflation. Again, no, they will not. They want to keep their publicity good. So what they're going to do is say what sounds good to make people calm down and maybe feel less anxious. Meanwhile, their dollar will continue to get obliterated, and their crypto holdings will probably have to liquidate to pay bills, or it won't go up either. So that's the reason why I do not like the decision. There's still money made. You're absolutely right. If you are a trader, volatility will still be there. It's going to go up. It's going to go down. That will always happen in crypto, in Bitcoin. But the question is actually improving your livelihood and improving your ability to spend and take care of your family, which again, money, both US dollar, the British pound, the yuan, Ethereum, Cardano, Bitcoin, no matter what it is simply a tool, a store of value to help you do what you're supposed to do. This is not a tool that's actually helping you do what you need to do. It's hindering. So,
yeah, we got 2 super chats.
Yeah, we did.
I'll read Tom Milks's first. Thanks for doing this live stream, guys. We need to do this more often for relevant news events when plausible.
Yeah,
I agree.
We will absolutely. And yeah,
and
so.
And there's another one.
Yeah.
$5 from Garush Abelian.
I'm glad you read that name. I would have butchered it.
Garush Abelian. When you guys think...
What you guys think
$5 Bitcoin today, how much dollars would it be in 2030?
That's a hard one. Do you have a thought? Do you have a stab?
$5 and 20. So ARK Investments and others.
How did you guys decipher that?
Arthur Hayes,
the question,
I think is his name. Yeah. Arthur Hayes, the founder of BitMEX.
That makes sense.
So they have it pegged at $1 million in 2030.
Yeah,
I don't think that's too far off, especially if inflation keeps running off as the Fed increases the rate at an unprecedented level. I think we'll be at $1 million in no time on Bitcoin. So would be 5 times
Oh, I understand.
Whatever.
Yeah, no, that's
You
okay.
would divide 1 million by whatever 50,000.
There's
roughly.
predicting 8 years from now, we could be anywhere between hundreds of thousands, meaning like 200, 300, 400, depending on if we're at a top or a bottom. We could be over the million. We could be at a peak and be sitting at like 1.5 million or maybe even 2. So that's a hard one. I know it's going to be worth more than $5. It's going to be worth more than $5 for 2 reasons. One, the dollar will continue to be inflated and be worthless, and number 2, the value of Bitcoin will continue to go up. So there's 2 different factors raising it. But if I were to try to pinpoint the exact number, that is impossible.
My guess would be you're adding what, 2 more zeros, because it's at 5 zeros now. 5 decimal places.
There are
5.
2 things. There are 2 factors that are raising the price of Bitcoin right now because we still, and I understand why, we see Bitcoin's value in terms of US dollars. Here's the thing. 1, Bitcoin is becoming increasingly more valuable as the demand increases. So even if the US dollar stopped getting better or worse, Bitcoin's value will go up. That will increase the value. And the second thing is, as the dollar continues to die, even if Bitcoin's value didn't increase at all, as the dollar dies, well, of course, Bitcoin's value is going to go back up. So that's why when people say it could be $1 million in 10 years, well, it could be way higher, but that's not because Bitcoin's value went up. It could be $1 million just because it's worth at this level today. It could be higher because of how much farther down the dollar goes.
I would actually say the last thing on that is that if you guys are bad at math like me, because he's asking how much his $5 would be worth in 10 years, essentially, in Bitcoin. There's a website I used called Bitcoin profit/loss calculator, and literally you just type in what your entry was and then whatever number the exit is, and it'll calculate the fees and everything and how much you made. So $5, you just type in whatever. So we just say, okay, it'd probably be $1 million.
Yeah.
Type that in, it'll tell you how much your dollars are. So.
Yeah.
Awesome. Perfect, Smay. That's good advice.
Well, that is all we have for today's stream. We'll talk more about this tomorrow morning. For those of you who do not know, Jebb is out. He was definitely out today. At this point, I don't know exactly when Jebb will be back. More than likely, at least by next Monday. He's kind of at this point left it up to day, but I am going ahead and planning the rest of the week. It is probably going to be myself, T-Shroom, Smay. Friday we'll have Kelly back on. But if Jebb comes back early, I'll be very happy to have him back. But I don't want him to come back before he's done. Again, if you don't know what happened, you can go watch the Coffee and Crypto stream this morning. We talked about it a little bit. That's all we have for you guys in today's video. Make sure you smash that like button. If you are new here, thank you so much for choosing us to watch. Hit that subscribe button. We go live every morning from 10 a.m. to 11 a.m. Eastern Standard Time. We have a show called Coffee and Crypto Live, where we bring you everything you need to know about at least Bitcoin and other big coins in the crypto market. Again, that's all we have for you in this video. We'll see you in the next one. Peace.